Gary Ng is economist, APAC at Natixis, and joins me around the set here. Gary, just your initial reaction to this reading at 50.4.
Well, I don't think this is basically a very optimistic number, because if we look at the overall trend combining with the official manufacturing PMI, definitely things are still quite challenging. We do see a weaker demand domestically. There are also a broad deceleration in small and medium enterprises. So basically the divergence between the official versus the Caixin one is really about the better export orders, which basically means that global demand is still relatively resilient compared to China's domestic demand. But with all the geopolitics events that we're seeing around the world, who knows how long it will last.
And is this a further call for stimulus from China? I mean, the market, everybody is still waiting.
Well, yes, definitely. And of course, when we look at the first half of the year, we do see there's a quite strong support from the external demand on the Chinese economy. But when this engine actually starts fading further in the second half, then of course the government will need to work harder on the stimulus. And I think one of the biggest change that we will need to see is really from this very supply focus, which will of course affect the manufacturing sector the most, towards the more demand focus sort of policies. We do see a bit of this shift after the period's important political events in China back in July, but we haven't seen strong enough yet.
Do you think Chinese officials are willing to accept sub 5% growth this year?
Well, it's always a relatively ambiguous target compared to the past on really chasing a fixed number. And of course, from what we are seeing right now, it's probably a bit challenging for China to really reach this solid 5% as mentioned on paper. But if we are talking about somewhere around 5%, let's say 4.8, I think it is still achievable for China. And the gap will really depend on how far China will be willing to expand its fiscal and monetary policy, of which we haven't really seen very big action so far.
Yeah, what would, Gary, big action look like? I keep wondering, go big or go home, right? But it doesn't seem like Chinese policymakers want to take that big step.
Well, I do think that the most important point here is really about confidence. And so far for the policies that we see, it has really been, I would say, more baby step in terms of, having certain support here and there. It doesn't really give investors, corporates and households that feeling that the animal spirit is back, that people are willing, or basically they are optimistic about the outlook. So I think for China to really change further, I think the Fed dovish stance will help a bit further on the monetary side. But it will need to basically send a stronger message from the top-down level in basically stimulating the economy further and allowing greater room for the local governments to act. So we have seen some action so far after July again, but this may not be strong enough so far.